That would be a triple net lease. It amounts to management by mailbox, meaning about the first of the month, you walk to your mailbox at the end of your street, you pick up your rent check, and then you turn around and write a check for your mortgage to your lender. It doesn't get simpler than that.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 83. Today's conversation is going to be a real treat because we're going to discuss something we've never talked about on this show, and that is the similarities and differences between commercial residential investing, such as multifamily and apartment buildings, versus other types of commercial investing, such as office, retail, and industrial. And here to discuss these various types of commercial properties with us is Michael Cagen, a senior associate with Marcus & Millichap. Michael specializes in investment real estate, including multifamily, multi-tenant office, industrial, self-storage, and retail properties. Michael also has 28 years of commercial real estate experience and holds the prestigious Certified Commercial Investment Member designation, or CCIM. Michael, welcome to the show.
Brian, thanks very much. Appreciate you making time today for me.
Well, it's great to have someone with your experience in other types of commercial properties with us on the show today. Why don't you fill us in a little bit more about yourself?
Well, I'm somewhere in my 50s. I've been in commercial brokerage for about 28 years or so. I was with a jack-of-all-trades firm doing retail, leasing, office, industrial, some multifamily. I ended up gravitating towards investment property when I realized that that was a specialization within the industry and that it's not user-oriented product, it's investor-oriented product. I joined Marcus & Millichap maybe 11 years ago or so. They had recruited me when I had done a successful multifamily deal with one of their brokers out of the Detroit office. So I've been with the firm for 11, 12 years. It's been a tremendous run. It's been great.
And you're also a real estate investor yourself.
Yes. Also do some real estate investing, multifamily investing.
Why don't we start with that? Where I'd like to go with this conversation today is talk about a little bit about multifamily investing versus the other types of investing or investment product that you bring to market as well. I mean, you do multifamily brokerage, but you also do other types of commercial.
That's correct.
But let's start with the multifamily, and let's start with your own personal experience investing in multifamily.
Well, my own personal experience started in 1986. I was not in the real estate business at the time. I was in the shoe business in Chicago, and a close friend of mine said, "Hey, Cagen, you have good credit, right?" And I'm like, "I don't know. I pay my bills." And he said, "Well, do you think you could borrow $30,000 from the Bank of Homewood, Illinois?" And I'm like, "I don't know. Maybe. Yeah. Why? What are we going to do with this?" He said, "Well, there's an FHA foreclosure on a townhouse in Country Club Hills, Illinois, that we can buy for $24,900, and I need somebody to partner with." And I thought, "Wow, that's so we're going to borrow $30,000." To borrow something for about $25,000. And I said to my friend, "So then we each take the $2,500 out, from that excess?" And he's like, No. There's going to be carpet and paper and paint and appliances and vinyl. And we're going to need money for advertising, and we're going to need money, basic real estate 101 stuff that I had no exposure to. Anyway, we bought it. And my question to him was, why can we buy something for $25,000? Why would the bank lend us $30,000 to buy something for $25,000? And he said, "Because it'll appraise at 40." And I thought, wow, there must be something to this real estate thing. Just imagine if I had some knowledge. We had it. We had a successful transaction. We recently sold it, I want to say, in 2014. When we had zero debt on it and had taken money out over the years, and it turned out to be a decent experience, And
it got you into the business, too.
It was a contributing factor for me getting into the business.
Yeah, what'd you end up selling it for?
$26,000.
Okay. You know what? That's the problem with buying in condo communities, because you're kind of beholden to the HOAs and just the condition of the community itself. I've had the same exact experience buying something in a condo community, paying $60,000, and I just sold it last year for around $25,000 myself.
Right. Brian, there were years. There was a period when this was worth $60,000. And, my partner and I sat there all fat, dumb, and happy. And we're like, it's great. Why would we sell now?
It's going to keep going up.
Well, it has. So, it's not broken. Why fix it? Well, demographics change. New competition comes into the market. Things changed. And I wasn't local to the property in Country Club Hills, Illinois, and wasn't able to see it. We weren't monitoring value on a regular basis. We didn't have an exit strategy. We didn't, in our mind, say, you know what, when it gets to X, we're going to make a move. We didn't have a strategy. We just bought it to hold forever. And, we didn't get hurt. But it would have sure been a lot nicer to sell it for $50,000 or $60,000 than it was for around $25,000.
The only thing good about selling at a loss is the tax write-off.
Sure, that's right.
You get at the end of the year.
Well, we had it from 86, 96, 06. We had it for give or take 20 years, so we depreciated a good 2/3 of the value of it. So even though we sold it for about what we paid, we had been taking depreciation each year. So there was tax on recovery. But hey, you know what? My attitude on taxes, if I have to pay $1 million in tax this year, I'm going to be so freaking happy. That would just be ideal. That would make my day.
So you also have invested in other multifamily as well.
Yes. One of them is an 8-unit townhouse in near 32nd and Schaefer, which I've had for quite some time, and it does quite well. I've got a 27-unit downstate and a couple of small pieces in a couple of other smaller areas.
You understand the draw of investing in multifamily. Commercial, especially commercial multifamily.
There's a number of reasons why people get involved in the product. There's a number of things that multifamily investing brings to the table. The depreciation that the government allows is at a more accelerated rate than in other categories of property. If you're buying something for easy numbers, if you buy something for $29,500, let's just say, since that's the depreciation that's allowed, the government allows you to write off that investment being the portion of that real estate that's above the ground. You subtract off the value of the dirt because you don't depreciate dirt. But if the value of the improvements above the ground were, say, $29,500, you're writing off that investment on a 29.5-year schedule. That is, you're taking a paper loss for basically, in that example, $1,000 worth of the investment each year. So that becomes a form of tax shelter. For you to be able to take a loss without it costing you cash, for you to take a credit against the income, which is cash income with a paper loss or a paper credit, that's a beautiful thing. In general, if you can put off paying taxes until a later date, in general, that's a good thing.
So, yeah, I mean, there's great tax benefits to investing in real estate and multifamily. Do you get those same tax benefits investing in other types of commercial real estate?
Other commercial like office, retail, industrial, I think the depreciation schedule is closer to 40 years. So you don't get to write off the same percentage each year. You don't get to depreciate the same percentage each year. Going backwards a little bit to the question of why invest in multifamily, depreciation is one of the things. Another thing is to actually grow your investment. That is to buy it for $25,000 and have it be worth $50,000, hopefully, and to be smart enough to sell, so that you're getting some gain in value, which is principally coming from the growth in rents. It's not going up in value if your rents are going down. If your rents are going down, your value is not going up. You are also able, of course, to write off interest expense. And in the first years of the investment, if you've ever looked at an amortization table, of course, you would know that the amount of interest is the greatest in the first several years, and it gradually tapers off. So your interest write-off is greater in the first years. That's across the board, whether it's multifamily or office, retail, industrial, self-storage. So there's, another thing that investors are looking for is principal pay down. If my tenants are helping to make my mortgage payments, that's a beautiful thing. Mm-hmm. If I'm picking up some gain in my equity in that property via principal pay down, that's a good thing. And that's one of the benefits you're getting over time. The flip side of that is risk. If you bought it for $100,000 and you have $75,000 worth of debt on it, maybe it works. We would hope it works. If the property then becomes worth $80,000, you probably have a loan covenant violation. Your lender is probably not real happy. Or if you're choosing to sell, if your life changes at the time and you're like, all right, well, it's time to sell. It kind of doesn't really matter what the value is. It's time to cash out of this. The lender wants the loan, or we just don't like this anymore. Great. You're selling it for 80. You owe the bank 75. There will be transaction costs. And oh, by the way, because you've owned it for a while, you've probably depreciated some of it. You may owe tax on it, even though you're selling at effectively a loss. Yeah. But
So talking about that risk in multifamily, the risk in any investment is that the value could go down. One of the things about multifamily, though, is that multifamily was the first asset class to bounce back from the Great Recession. And it's still a very hot asset class right now. I mean, everybody is looking to get into multifamily and apartments. So why would anyone consider investing instead in commercial office or commercial retail or commercial industrial?
Well, there's people that have experience, familial experience or investing experience, or I'm thinking of the retail category. There are a lot of people who have maybe had retail businesses that think, all right, if I own this building, I'm going to be able to put somebody's retail business in here. Some of the characteristics on that kind of product type, you tend to not get the midnight call saying that the drain is backed up, so there can be fewer management issues with a retail property. You tend to have leases that run for a much longer term. You tend to have properties that have built-in rent increases. So there's various reasons for you to like that category. It may also be, one of the things, I think we sold like $7 billion in single tenant net leased property, which is there's one tenant occupying the whole building. A lot of the tenants that you see, a lot of the household names that you see, those retailers don't own their own spaces. They lease the space.
So give us an example.
Sure.
So starting with retail, so what's an example of some of the retail?
The recent retail property that I sold was a single-tenant Dollar General in Pentwater, Michigan. It was new construction. So Dollar General, they don't own their own real estate. They operate it. It's not a franchise or anything like that. You're getting Dollar General's actual credit. Dollar General's real estate department will go find developers to go find them sites. They might say, hey, we want to have 75 stores in the state or 175 stores in the state.
And Dollar General likes to have their own standalone building.
They tend to like to have their own standalone building. And that's not to say that they're not in retail strips, but they are often in freestanding buildings.
And when you say single tenant, that means the Dollar General is the only tenant in this. Like if they're in a freestanding building, they're the only tenant in that building.
Exactly.
So that's a single tenant net lease.
Yes. The investor that I was working with had recently sold off a property that they had. They decided that they no longer wanted to own that particular retail location. They considered that retail location to not be where they wanted to have their money tied up, or they may have co-owned that with other family members, and different family members went different directions. This guy was able to do a tax-deferred exchange, a 1031 exchange, which we can talk about if you desire. And he put his money into this Dollar General in Pentwater. At the close of the transaction, Dollar General executed a new 20-year lease, and they were responsible for all aspects of the operation of the property. They're certainly they're certainly responsible for their own income and expense and stocking that's not on the landlord. Landlord, I believe, had responsibility just for the roof and the structure. Beyond that, you don't have to go to the property. You're not paying the water bills. You're not paying the electric bill. You're not shopping for snow contractors. So you're
not maintaining the landscaping.
You're not maintaining the landscaping. Landlord is not maintaining any of that.
Are you paying the property tax?
In that particular instance, the tenant would pay the property taxes direct. The tenant would get the bill, and the tenant would pay the taxes directly to the municipality. Mm-hmm. So that's a very hands-off, carefree investment.
Now, would that be considered a triple net lease?
It was a triple net lease. Mm-hmm. Triple net meaning the tenant is responsible for the tax, insurance, common area maintenance, all of the monthly expenses or quarterly expenses that you would have associated with the property. That would be a triple net expense. That would be a triple net lease. A lot of investors choose that. It amounts to management by mailbox, meaning about the first of the month, you walk to your mailbox at the end of your street, you pick up your rent check, and then you turn around and write a check for your mortgage to your lender. It doesn't get simpler than that.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
Now, because of the simplicity of it, because of the lack of risk of it, the yield or the rate of return is going to be low. Anybody can own that. You might be the brightest, most sophisticated real estate ever in the history of the world, and you know what? You can't add value to that property.
Right, because the value is baked in for the next 20 years.
The value is pretty baked in. Mm-hmm. It's fairly baked in. Let me challenge you on the value being baked in. If I had two Dollar Generals to sell you, I'll frame this in a question. If there were two available, one had a 20-year lease remaining, one had a 3-year lease remaining, which do you expect you would be paying a higher price for as an investor?
My guess would be you'd pay a higher price for the 20-year
Absolutely.
lease because that's a given. For that, as long as it's a tenant like Dollar General, who you can be relatively safe in assuming they're going to be around for the next 20 years and not go bankrupt. That's a much more conservative, simple deal to do.
It's more conservative, absolutely.
And I'd imagine if the other one where the lease is up in 3 years, well, then you have to worry. Well, I have to find a new tenant in 3 years, and will this property sit vacant for the next 2 years after that? And then will I have to put tenant improvement money into it once we do sign a new lease?
Those are all going to be factors. If you're looking at that 3-year deal, those are all going to be factors that are going to contribute to you as an investor looking at that 3-year remaining term and say, I wouldn't pay as much for that. You might buy that property. There's nothing wrong with buying that property, but the yield you're going to be buying that for is going to be much greater to you in order to offset that risk. One of the other risks is that, sure, the tenant might leave at the end of 3, They might not exercise a renewal option. Is that space worth what that tenant was paying? Or is it going to be worth more? Is it going to be worth less? That too can have an impact on, it's an economic impact. I've got an investor who owns a Walgreens that I sold. He had a tax-deferred exchange to do. He selected this particular location. We've been talking recently. The tenant has a right to terminate every 5 years. They've been there for 30 years or so. And after that, they have the right to renew or terminate, depending on how you look at it. The day that the tenant's right to terminate the lease passes, and they have a 1-year termination notice, if they don't exercise their option to terminate in a year, then that's going to mean there's 1 year remaining, plus they have effectively renewed for the next 5. Right now, it's a lease that has it's a Walgreens that has 15 months to run. As an investor, you're going to look at that and say they can get out in 15 months. When that tenant doesn't terminate in April of next year, that's the moment that property for this particular investor, becomes a sale candidate, because at that point there's a 6-year lease remaining.
Okay, because due to the fact that the Walgreens did not file any sort of notice that they were going to terminate the contract, that automatically renews the contract for another 5-year period beyond the 1-year window in which they they have upon the termination notice. So because of that, so 5 years is a strong enough term to be able to attract another investor who might want to buy into a Walgreens that still has 5 years to go on their lease.
Well, the property is saleable right now when there's only 15 months to go, but it's going to be worth a heck of a lot more when there's 60 months to go. Mm-hmm. So it's saleable. It's just a different risk profile of the buyer. And Walgreens was 6 years to run, and it's an older location, so the tenant is only paying like $13 a square foot in rent, which is fairly cheap, $13 per square foot per year. It's fairly cheap. That will be more marketable. It'll be more marketable. Investors are going to be willing to pay a lot more for it.
And the tenants are so important in the retail world. In the multifamily world, your tenants come and go. I mean, if you're lucky, they stay 2 or 3 years, and then they move out and new tenants move in. But quite often in the retail world, you might have a single lease tenant, or you might have a strip mall where you have 5 or 6 different businesses. But the emphasis on the tenant is a lot more important in those situations. Can you talk a little bit about that, like just the credit rating or the credit worthiness of the tenants that you look for?
Well, some examples of single tenant net lease, the brands that you hear: Walgreens, CVS, Rite Aid, Advance Auto, Dollar General, Family Dollar. There's any number of McDonald's, Starbucks, Burger King, Wendy's. There are any number of the national brands that you would see that you're familiar with: Denny's, Red Lobster, all of those.
The blue chip companies that have been around for a long time and have a lot of stability to them.
Right. There's their debt. They're publicly traded firms. Their debt is traded. Their debt is rated. So you can look at something like CVS, which is a very, very strong tenant. As an investor buying a CVS leased deal, you have maybe 0.2% of the probability of the tenant going bankrupt in any given year. That's really, really, really low. If you had a tenant, I'm just trying to think of who recently went bankrupt.
You have like the Radio Shacks, the Circuit Cities, or
sure, Radio Shack. I believe is completely out of business. A few years ago when they were still around, they had declining revenues every year. They had unprofitable locations. Their outlook wasn't good. And I don't know off the top of my head what their credit rating was in the year 2 or 3 or 4 before they cratered. But if they had, say, a B- credit rating or a C- credit rating, or depending on what the different rating agencies refer to them as, and you can easily search online for any one of those brands and see what their credit ratings are and what the default risk is. But it might have been a 25% probability of a default in any given year. So you might have a 10-year lease remaining with Radio Shack, but there's a 25% probability that they're going to go bankrupt in any given year. Okay.
So the value of that property is going to be a lot less than if it were a CVS or a Walgreens.
Absolutely. Absolutely. And, as an investor, if you're looking at a retail strip center that has Family Dollar, decent credit, they have Radio Shack, not good credit, and they have a couple of ma and pa retailers that are startup businesses, and that's their only location. You might, as an investor, be looking at each of those different tenants with a different perspective on how long they're likely to be there. And that's going to influence your opinion of what you'd be willing to pay for it.
What about the way you value these properties? Because, and this is something I want to get into, which is kind of in multifamily, you're basically paying for the door or a unit. If you buy an 8-unit property, you can usually break it down to, I paid $60,000 a unit. But with retail or other types of commercial, quite often you're talking about square footage. Can you kind of explain how these other types of commercial properties are valued using the square footage?
Square footage is one of the units of measure. The price you're going to pay per square foot, let's say you see a Starbucks, and we sell a lot of Starbucks. Starbucks corporate runs the store. You're not involved in the day-to-day. You don't become the barista when you buy a Starbucks investment, all right?
You won't be sweeping the floors.
You won't be sweeping the floors. You won't be asking, would you like me to leave room for cream? No, none of that. You're simply you're simply walking in the mailbox once a month to collect your check. Those deals tend to have actually a fairly high price per square foot. You might be paying $300, $350 per square foot to buy a Starbucks. Why is that? Well, they tend to be in high-profile locations. They tend to have drive-throughs, which is very often regulated by the municipality. Not every municipality wants drive-throughs.
Which means they've already got an approval for the drive-throughs.
Right.
And it's,
which is a scarce commodity, supply and demand. Mm-hmm. So they're in high-profile locations. They're in locations that you can easily get in and out of. And they come with a very strong corporately backed lease. So you might be paying $300 a square foot for it. Now, you can look at that and say, but that building couldn't have cost more than $150 to build, $175 a foot to build. Right. So what? What's your point? You're buying the credit of the parent corporation. Yes, you're paying more than the intrinsic value of the bricks and mortar. Okay, fine. You are, right? But it's you're buying a credit. You're buying Starbucks credit. Price per square foot is a useful unit of measure. Brian, on a Walgreens deal, there's a Walgreens that I'd sold back in the day at the southwest corner of Lake Michigan Drive in Wilson. And the tenant was only paying about $12 a square foot, which is relatively low. That property, let's just arbitrarily say you bought it for easy math, tenant was paying $12 a foot. It was 10,000 feet. So it was, let's say you bought it with a 10% rate of return. The number of dollars per square foot you were buying that for might have only been $120 a foot. Now, does that make it a better deal than a Walgreens in South Beach, Florida, where the tenant is paying $65 a square foot, and you have to buy that deal for $850 a square foot? Which is a better deal? Well, on a price per foot basis, you've got one at $850 and one at $120. It's a unit of measure. It's not the only unit of measure. If you drill down and look at that, well, the Walgreens at Lake Michigan Drive in Wilson has 6 years remaining. The Walgreens in South Beach, there was no competition in the area. It's a replacement Walgreens from a different site. that they didn't come to terms on their landlord with. You've got brand new construction. You're in a high profile, high traffic, high visibility area in a high income area, and there's 25 years to run. Which is a better deal? It's what's your risk tolerance? What's your comfort level?
Yeah, it really seems like price per square foot, cost per square foot is in the same category as cap rate, which really just it prices in the risk and other factors such as location, credit worthiness of the tenant, type of tenant you're going to get, quality of people who would come to that area. So it's just I get your meaning there. It's one factor.
It's one factor. You mentioned cap rate. You might be looking at a Walgreens in South Beach at some ridiculously low cap rate, maybe 4.75%. In other words, if you're buying that deal for, say, $10 million at a 4.75%, your cap rate is, if you were to buy the deal on an unleveraged basis, cap rate will equate to the return that you get on your investment.
On an all cash investment.
On an all cash investment. If you buy something for $100,000 and it's a 10 cap, you expect there to be $10,000 worth of net operating income that remains. Net operating income, you've got your gross revenue, you've got your ordinary property operating expenses. What's left over is the net operating income. If you're buying something for $100,000 that has a net income of $10,000, you have a 10 cap investment.
It does seem like, though, when it comes to cap rate, that if you're buying a triple net Walgreens at a 5 or 6 cap, you can pretty much be certain that that's going to be a true 5 or 6 cap, because you're not going to have the fluctuating expenses or income that you get in the commercial multifamily. If you buy an apartment building at a 5 or 6 cap or an 8 cap, well, that may not come to fruition for a couple of years because you might have a lot more expenses that you have to put into the property going in, and your income can also fluctuate. So it does seem like you're getting a much more secure cap rate if you're investing in a good quality triple net tenant in the retail world.
It's a lot more predictable. Absolutely. You're not going to get shocked with, wow, we had a bad winter. We had tremendous snowplow expense. No. On your apartment, you will. Mm-hmm. And you're not passing that on to the tenant. You're eating it. The landlord's eating it. On a single tenant net lease, Starbucks, well, whatever. Sorry you had a bad winter. Sell more coffee.
Yeah. Go back to the corporate office and get the money from them. Let's talk a little bit about office space. Do you also deal in that world as well?
Yep.
So fill us in on commercial office space. What are the factors that we need to take into consideration there?
Well, there was a relatively recent transaction, sold an office park in Battle Creek. I want to say 5 buildings of about 10,000 square foot each. Good highway visibility, good highway access. It was a relatively diverse tenant base. One building was 100% occupied by one tenant. Another building had maybe 2 tenants or 3 tenants, and the other buildings were mixed with smaller tenants. Everybody had different lease expirations. As an investor, you have more to manage there. There were maybe 15 tenants, 20 tenants, I don't recall exactly. You have lease expirations to monitor for each one of the tenants. You have the overall market to monitor. You have some vacant space, which you certainly want to get marketed because it's costing you money. You're not generating anything on that vacant space. It's costing you money for real estate tax. You have to put in some minimal utilities so you don't blow pipes. You want to get as much as you can, but what will the market bear? You're looking for a good leasing broker who can bring you the market and bring you market rate deals. A good leasing broker knows who's out there looking. And a good leasing broker is tuned in to what sort of concessions landlords are offering to tenants as inducements to move there. Is it X number of months free rent? Is it $35 a square foot in improvement money versus you're taking it as is?
Which would be TI, by the way. So that's an important term to to understand is TI, which is tenant improvements. And quite often in an office or even retail or industrial, if you lease to a tenant, they might expect you to help pay for some of the build out to get their offices in there, or to basically build out their offices the way they want them to. So when you say $35 a square foot in TI, that's what you, the owner, would have to pay toward that tenant's build out. And that's an incentive that is used to get them to sign a lease.
Right. And an astute tenant is comparing the deal that you're offering versus the deal that they can get in a theoretically comparable building nearby. One of the things that some tenants will drill down to is, okay, you're going to give me X number of dollars in TI and improvement money, but we don't want new carpet and new paint to be a part of that. We expect you, the landlord, to give us new carpet and new paint because nobody would move in the condition that it's in.
So it's all part of the negotiation.
It's all part of the negotiation.
Now,
right.
do you deal with the leasing as well, or are you strictly on the brokerage side?
We do no leasing. We don't do any leasing. If you have a lease need, I can put you in touch with the right leasing broker for the right product category. And it's not going to be somebody from our firm.
So those negotiations, though, with a tenant and the owner of the property take place on the leasing side.
Absolutely.
Like that's all part of the leasing contract that would be put in place.
Right.
What are some of the other factors there? I know you might lease at a certain square foot. There's tenant improvements. There's the lease negotiation and all that. As an investor looking to invest in office space, what are some of the considerations I would need to take into account?
When do the various leases renew? What termination rights do the tenants have? What kind of increases do the tenants receive? Are there any limitations on the pass-through expenses that you get to send to the tenant to reimburse you for? I have seen leases, particularly with stronger tenants, that might say, in the event the taxes go up faster than the rate of inflation, it's not our problem, basically. The tenant doesn't want to be responsible for the increase in tax. They'll pay the real estate tax, but if the taxes go up dramatically, like when the property tax becomes uncapped, there could be exposure to the landlord. Could be. Not saying that there is. There could be exposure to the landlord. It tends to be unusual. Most of the time, there are not limitations on the pass-through of expenses, but that's going to be something to look at, along with cancellation rights. You're going to look at co-tenancy clauses. One of my owners had a dance studio. Next to it, he put a medical marijuana dispensary. Even though the tenant didn't open for business, the dance studio walked away from their lease. They didn't have a termination right. They just said, look, we can't expect moms and dads to bring their young kids,
7-year-old daughters, to dance next to a marijuana dispensary.
Next to a marijuana dispensary.
Yeah.
There wasn't a prohibition on it, and it's not like the tenant has the right to walk away. Okay, go after the tenant for your damages. Just because there's a lease doesn't mean they're sticking around. There may be deed restrictions on a given property. I remember seeing a property, and I believe it used to be owned by one of the hamburger chains. I remember years and years and years ago seeing a deed restriction saying that there can never be hamburgers sold on this real estate. Because McDonald's, for example, used to own it, and then they went to a different location. They wanted to make sure that there wasn't going to be a new burger chain opening up on that site that would then compete with McDonald's. So there's all sorts of goofy things.
They poison the well.
Yep, poison the well.
Yeah.
I saw a deed restriction on a property in Jenison that reserved the proceeds, I'm not making this up, that reserved the proceeds of a bank robbery that were believed to have been buried on the property. It's like, okay, great. It sounds like a contract for an illegal thing, which is then not enforceable, but whatever. I'm not an attorney.
It's kind of like reserving the oil or mineral rights on a property in a way.
A little bit like that, except you actually can reserve oil and mineral rights, which is something your typical title insurance property, not that you want to have a discussion about title insurance, but we can. Your typical title insurance policy does not insure against claims for mineral rights from other people. The last apartment building you bought, Brian, unless you got a rider for mineral rights, you may have not bought the mineral rights for that property unless that was a specific part of the negotiation. Mineral rights can be separated from the property. I sold a property, I think in Lakeview, that had mineral rights that were reserved to a different owner. The owner leased the land to some entity that wanted the mineral extraction rights. When we sold the property, we dealt with it, but you're not, as a rule, necessarily buying all the, for whatever reason, mineral rights are a separate animal unto themselves.
Well, let's talk about with the retail, we had talked about triple net leases, but that's where the tenant is paying everything. And that's not, and quite often it's not a triple net lease. Can you talk about some of the other permutations of the types of lease, especially when you get to office, of the how it breaks up the responsibilities of what the property owner pays versus what the tenant pays?
An office park that I sold in Kalamazoo a few years back, all of the tenants were only responsible for rent plus individual utilities, gas and electric, metered to the suite. Landlord was responsible for roof, structure, window washing, landscape, insurance, lawn, snow, trash, water. The characteristics of that property, it was an older office park. And in the older office park, where image is less of an issue, perhaps for the tenant, you're renting that space for less money, it tends to not be high end. There was nothing wrong with it. It was in good, reasonable physical shape, but it's not brand new with the most modern amenities and the highest profile location. It had a good location. So a characteristic very often in an older office property is that the leases will tend to be gross plus electric, meaning you pay your rent plus you pay your utilities.
Is gross the opposite end of the spectrum then? So you have triple net on one end where the tenant's paying everything, and then on the other end you have gross, where
yes,
the tenant's basically just paying the rent and the property owner's paying everything else.
In a general sense, I would agree with you. Yes, triple net tends to be the landlord passing through all of the expenses of operation of the property. In a gross lease, the landlord is eating all the expenses of the operation of the property, with the typical exception of utilities that are separately metered to the suite.
And then I hear the term modified gross rent quite often. What would that be?
One of the slightly scary things is that there isn't always an answer for that. There isn't necessarily a uniform answer for that. A modified gross might be gross plus electric. Mm-hmm. That could be considered modified gross.
It seems like an interesting and subjective spectrum between triple net and gross, where you have triple net, then you have double net, then you have single net, and then you have modified gross, and then you have gross. I mean, does that pretty much cover the spectrum there? Pretty
much. Although at the far end of the spectrum, when you were talking about triple net, is something called absolute net. Mm-hmm. And in an absolute net lease, landlord has no exposure to the roof or structure or parking lot. Triple net, landlord will very often be responsible for roof and structural maintenance. In an absolute net lease, tenant is responsible for everything. I did a sale leaseback for a company. Company owned the building. I don't think they had any debt on it, and they wanted to no longer own the building. And their attitude was, we know the property. It's not perfect, but we're comfortable with it. We sold the property with a 12-year absolute net lease in place. Tenant is responsible for every darn thing. If the earth shifts, tenant, and it breaks, it causes one of your walls to collapse, tenant, I hope you have good insurance, because you're responsible for it. You have to pay rent regardless. So in an absolute net lease, tenant is even responsible for the roof and structure and parking lot. Yes.
The only thing they would not be responsible for would be the mortgage payment that the owner has on the property.
It's not the tenant's problem. You're talking about a triple net or an absolute net at one end where the tenant is responsible for all elements of the operation of the property versus gross plus electric, like in the office park that I recently sold in Kalamazoo, where the tenant doesn't have exposure to any of those expenses. And it might be easy to say, well, as an investor, then I'd want a triple net lease. I'd want to buy an investment that has triple net leases or absolute net leases. Okay, that's fine. You can expect a lower yield because you have no exposure. If you're buying, conversely, an office park that has gross plus electric leases, expect a higher indicated yield because you are exposed to weather. You're exposed to having to repaint the exterior of the building. You're exposed to the expense of replacing plumbing when it goes bad in the common area restrooms. It just depends. It depends on what you're looking for.
Okay. Yeah. Thanks. That helps clear it up in my mind because I've always, I realized it was somewhat subjective, but now I realize it's completely subjective.
It can be, yes.
Yeah. Do you also do industrial as well?
I've done some industrial. The industrial that I tend to do would be the sale of industrial investment properties. An example on that would be a FedEx distribution facility that I sold not too many years ago. FedEx had a long-term lease on a distribution facility, and for whatever reason, the investor that owned it didn't want to own it anymore. My investor bought it, and they've owned it quite successfully and have been responsive to the landlord and have added on when the tenant wanted them to add on. Those tend to be good, stable deals, particularly today when so much of what you might be buying for household use comes via FedEx, UPS, U.S. Postal Service.
Yeah, I'd imagine owning a FedEx or Amazon warehouse or some sort of facility like that would have a pretty long-term strength to it.
Right. Exactly. Brian, I remember seeing the appraisal on that particular FedEx facility and being surprised that the appraiser put in a couple of % vacancy factor. And I remember challenging the appraiser on it, and I was like, why would you put a couple % vacancy factor on here? The property's fully leased. It's going to be leased for another 15 years. And the appraiser rightly said to me, in the event they leave, they're 100% vacant. So there is some risk that the tenant will vacate, either because of their credit or because the lease term ends. It's a buffer that reasonably should be put in.
To me, the major risk in investing in office or retail or industrial is that if your tenant leaves, you're 100% vacant.
Right.
In multifamily, at least, if a tenant moves out, you've still got 8 other tenants or 100 other tenants. And you can get one in relatively quickly. Finding a new tenant in any of these other types of commercial properties can be a long-term proposition.
It can be a long-term proposition. In the office, we've tended to be discussing multi-tenant office. There will be vacancy. There will be turnover. That's just in the normal course of business. If you have a single-tenant office, they're going to tend to be sticking around there. You're 100% full or you're 100% vacant. There's no in between.
You also have a lease that says, okay, they're going to be there for the next 5, 10, 15 years, and then they might leave. But at least you know what period of time they're going to be sticking around for.
What period of time they're contractually obligated to stick around for. Yes.
You've obviously helped investors buy a lot of these different type of properties. Is there a sweet spot or a place where a lot of investors really like to put their money, whether it be office, retail, certain type of tenant?
Interesting question. I mean, the majority of the work I do is the sale of multifamily property. Having said that, I've just in the last quarter hour or 30 minutes described the sale of industrial property, multi-tenant office, and single-tenant net lease retail. Our company feels that single-tenant net lease property tends to be for investors who no longer want to actively manage their real estate. You right now, Brian, are invested in a couple of different multifamily properties. You have the time, you have the talent, you have the resources and risk tolerance to manage or oversee the investments in your multifamily investments. 20 or 30 years from now, you might decide, all right, I still want to invest in real estate, but I don't want this day-to-day monkeying around. Well, you're a great candidate at that point at a later stage in life for single-tenant net lease deal. I don't tend to find somebody in their 30s who's like, I want to buy a Starbucks because I want my investment to just stay there and not grow in value, and to actually have the value go down a little bit as the lease term burns off. Where I find investors interested in single tenant net lease tends to be at later stages of their life.
And that makes sense.
Makes sense.
If 1031 exchanges are still around in 20 years, I think it would make all the sense in the world to sell off some of my properties, stop actively asset managing them, and just put it in something very stable. It's like a bond of some sort.
Exactly.
With a higher yield.
With a higher yield than a bond, yes.
Yeah.
And that can be a good tax deferral strategy. You mentioned doing a 1031 or tax deferred exchange. It can be a good tax deferral strategy. Most investors think paying taxes as far into the future as you can is better than paying them now. Having said that, I do have a client who's like, we know what the tax rates are now. When we sell a property, we do not do a 1031. I only have one client that has that attitude. God bless him. More power to him. We know what the tax rate is now. We can measure it. We can quantify it. We're going to pay our tax and move on.
Yeah. That's true. I mean, tax rates could be a lot higher when the time comes. Now, I think my 1031 investment strategy would be to just die eventually and never have to pay those taxes. But
take advantage of the step up in market value.
Exactly.
Right.
You and I have talked off mic about some of the benefits of working with Marcus and Millichap as a seller. Can you kind of expand on that a little bit?
I'd love to expand on that. Marcus and Millichap's platform is really all about bringing the greatest number of buyers to a deal. If I were to list your apartment building, most owners would want us to bring you 100 buyers. You would want us to be able to have 100 people looking at your property rather than me bringing it to my favorite buyer. When we bring more traffic to your investment deal, we have a greater likelihood of getting multiple buyers competing to get the same asset. And when you have multiple people competing to get the same asset, we're able to move them from the price they want to pay for your deal to the price they're willing to pay for your deal. The price may be higher than if we just bring one buyer. The terms are also a big deal. When we have enough traffic for a given deal, we might be able to dictate the length of term for due diligence. Buyers tend to want to have the property tied up for 60 days for all due diligence. If I only have one buyer, that's what the deal is going to be. Kind of. If I have multiple people competing for your asset, frankly, we get into a beauty contest where we're making buyers compete with one another for how quickly they can get the due diligence done. You're better off, Brian, in having a 21-day due diligence period for your property rather than having a 60-day due diligence period for your property. That is, making the buyer invest now in survey, in environmental, in physical inspections, in structural inspections, in roof inspections. Make them invest now. Get them, to use the politically incorrect term, get them a little bit pregnant in the deal so that they have some skin in the game, rather than simply having you tied up for 45 days before they get around to doing their due diligence. We want the buyer to have an investment in the deal. We want them to have a vested interest in the deal. There was an apartment transaction I did in Kalamazoo, closed maybe a year and a half ago. We priced it at the price we felt the deal would trade, which was $3.9 million, which is a different conversation unto itself. If we thought it was worth $3.9 million, why would we ask $3.9 million? Don't you ask like $4.5 million so that with negotiation you can hope to get $3.9? No. If we ask the price that we believe and all the data tells us this deal should trade for about $3.9, what that causes is, in essence, people to drop what they're doing to go look at the deal. You would look at this deal when it came out and go, $3.9 million for 99 units in Kalamazoo. I want to buy that. I don't necessarily want to be in Kalamazoo, but that seems like a fair deal. Yes, Brian, that's exactly the reaction I want. I want people to drop what they're doing and go look at this deal. We priced it at the price that we felt it would trade for, which was $3.9 million. I wrote 5 offers. Another broker from the Grand Rapids area wrote a 6th offer. The best buyer for the deal wasn't my buyer, and it wasn't this other broker's buyer. the best buyer for the deal came from our Washington, D.C. office from a broker by the name of Dave Gray, who had a 1031 buyer who was completely unknown to me. Dave Gray was selling this man's apartment building in a town called Greenbelt, Maryland, and he had a 1031 to do. Dave Gray's buyer was better than my buyer. Yeah, I didn't make out financially as well as if I was on both sides of the deal, right? There's a brokerage fee, and if I get the whole fee, then I do better than if I'm sharing the fee with Dave Gray. Yeah, it's not about me. It's about my client. We did a call for offers. We established a date certain by which everybody had to get their offer in. Then we took those 6 offers, took the top 2 or 3 that we felt had the highest probability of success, or maybe it was all of them, and we went to them for a best and final round, which is to say, hey, Brian, you wrote an offer on this deal. That's great. Put your best foot forward. Every buyer, Brian, called me, and the conversation all started out the same way, with the buyer saying, hey, buddy, what's it going to take to get the deal done? And the answer was, in essence, well, we already have an offer above our asking price starting at a 4. So right off the bat, you need to know that your deal has to start with a 4. We need a $100,000 earnest money deposit. We want your physical inspections to be done in 14 days, 21 days, something like that. We expect you to be contractually compelled to get going on that stuff. And oh, by the way, Brian, since you know that anybody that can fog a mirror can get financing, don't make your finance contingency my seller's problem. I know it's going to take you 60 to 90 days to get your financing, and I'm not asking you to close before you get your financing. We'll give you 90 days to close. We want to deal without a finance contingency. The successful buyer, Dave Gray's buyer, paid $4.4 million, had a $100,000 earnest money deposit, had a 21-day physical inspection contingency, and closed 90 days later. The competition that we were able to introduce to the property is what drove price and terms. I recently listed an apartment deal in Coldwater in Branch County. As soon as we list a property, the property immediately becomes searchable by about 1,500 Marcus and Millichap agents nationwide. Other agents will receive buyer needs alerts if they're looking for the product that I list, and it tells them who the buyer, who the alert was for. And they have the ability, that other agent has the ability to send the offering memorandum directly to their client. And on the back end, I have the ability to capture that information. It tells me which of those 50 agents have downloaded the offering memorandum. And it gives me a link to them, and it gives me their phone number. And the way I've utilized that before, I was selling an Advance Auto in Jackson, Michigan. And I received an offer on it. And it wasn't that great, but I wanted to try to utilize the tools of our system. And I then sent an email out to all the brokers who had received a flyer, a buyer needs alert on my Advance Auto. And I picked up the phone and I called the half a dozen people that actually downloaded the offering memorandum more than once. That suggests to me that they're interested in that property. I ended up selling it via one of the other agents who said, oh, really? You got an offer on that? Yeah, I've got a guy kicking the tires on it. Let me try to shake the trees and see if we can make something happen. His buyer bought my deal. The guy that I had for it didn't get the deal. We're designed, the platform of our firm, Brian, is designed to bring the widest possible audience to a given property. And we do that via what we think is expert underwriting and valuation, looking at the various units of measure, cap rate, price per square foot, cash on cash return. We're looking at the debt markets to see what kind of financing is available with the intention of correctly pricing the property and getting it out there so that more people will look at it, because we want to bring you 10 buyers, not one buyer.
Well, if there's a seller out there or a buyer who would like to get a hold of you, Michael, how would they do that?
Either email or call. My email is M as in Michael, Cagen, Cagen, mcagen at Marcus, Marcus, Millichap, which is Millichap, as in Paul.com, mcagen at marcusmillichap.com. Phone is 616-291-6222, 616-291-6222. We're interested in sellers. We're interested in people who are thinking it might be time to sell their investment property. We do get calls from buyers saying, hey, if you see any apartment buildings at like a 9 cap with no deferred maintenance that are all brick, and somebody that has to sell, will you call me? I try to be professional and not laugh at that question, as you just did. You recognize how ridiculous that is. Yeah. I actually get calls like that. Not interested.
That was 5 years ago, but not in 2017.
I had that call earlier this year, and I had to explain to them the reality of the market. But we're mainly interested in people with investment property that they're thinking about selling or are looking to sell. That's where we can be most effective for people.
Well, Michael, this has been a fascinating conversation. I really appreciate you taking the time to come and explain all the different variations of commercial properties and how to value them, your experiences in selling them. Thank you so much for taking the time to do so.
It's been my pleasure. Appreciate the invitation. Good luck to you and good luck to your investors.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.